Stop scrolling. If you're watching silver right now and you feel like you're losing your mind, you're not crazy. You're witnessing something that's never happened in modern markets. While everyone else is panicking about whether silver just topped or bottomed, you're here asking the question that actually matters. And what I'm about to show you is going to make you question everything you thought you knew about price discovery. Here's the number that should be keeping you up at night. As of February 5, 2026, silver is trading at $78.90 per ounce on the COMEX. That's down over 10% from yesterday and down 17% from the intraday high just hours ago. But here's what nobody's talking about. In Shanghai, that same ounce of silver is changing hands for $120 to $130. That's not a typo. That's a $40 to $50 premium for physical metal. When the paper price says $79 but you can't get physical metal in Asia under $120, we're not talking about a pricing inefficiency anymore. We're talking about two completely different markets. Let me take you back exactly 1 week. On January 31, 2026, silver experienced what analysts are calling an 8 to 9 sigma event. The metal crashed 30% in a single day, plunging from an all-time high of $121 per ounce to the low 80s. If you've been around markets long enough, you know that 9 sigma events aren't supposed to happen, ever. The statistical probability of a 9 sigma move is so small that it should occur once every several billion years. Yet here we are, and if you think that was just normal volatility, you're missing the entire point of what's unfolding. Yesterday, February 4th, something happened that the mainstream media barely covered. The United States convened 55 countries for the Critical Minerals Ministerial in Washington. Representatives from the European Union, Japan, Mexico, and over 50 other nations sat down to discuss one thing: breaking China's stranglehold on critical materials. Silver isn't just a precious metal anymore. It's a strategic industrial commodity. Every solar panel, every electric vehicle, every semiconductor, every military application requires silver. And according to the opening remarks released by the State Department on February 4th, the Trump administration is pushing price floors and flooding private equity into domestic mining operations. When governments start stockpiling strategic metals and 55 nations coordinate supply chain independence, that's not bearish. That's the setup for a supply shock. But let's talk about what happened in the last 72 hours, because this is where it gets genuinely strange. On February 2nd, after 2 days of brutal selling, silver staged a recovery. The iShares Silver Trust, ticker SLV, saw $3.4 billion in inflows in a single day. That's not a typo. $3.4 billion. Retail traders piled into silver faster than they bought tech stocks. Vanda Research reported that individual investors net bought $171 million of SLV on January 27th alone, nearly double the $93 million they put into their favorite tech names. This wasn't institutions. This was everyday people saying the crash was a gift. And then on February 5th, the rug got pulled again. Silver plunged another 17%, wiping out the entire 2-day recovery. Here's what I need you to understand. This isn't normal price action. This is forced liquidation. When you see a metal crash 30%, recover 12%, then crash 17% again in the span of 5 days, you're not looking at natural supply and demand. You're looking at leveraged positions getting obliterated. According to CME data, margin requirements on silver futures were hiked during the sell-off. When exchanges raise margin requirements during a crash, traders who are already underwater are forced to either post more collateral or liquidate. Most can't post more collateral, so they sell. And when they sell, the price craters further, triggering more margin calls, which triggers more selling. It's a liquidation spiral. And the institutions who have dry powder on the sidelines know exactly how this game works. Now let's talk about the elephant in the room. COMEX registered silver inventory. As of early February 2026, COMEX registered inventory sits at approximately 103 million ounces. For context, registered inventory is the silver that's actually available for delivery, if someone stands for physical. Eligible inventory is just silver sitting in the warehouse that could potentially be registered but isn't promised to anyone. Since September 2025, COMEX inventories have dropped 117 million ounces. That's a 22% decline to just 415 million total ounces, the lowest level in years. And here's the kicker. Open interest in the February 2026 contract, which is the front-month contract that's about to go into delivery, has collapsed to just 1,050 contracts according to MarketWatch data as of February 4th. Why does that matter? Because it means almost everyone who was long paper silver either got shaken out or rolled forward. The smart money took their chips off the table. But while paper traders were getting liquidated, something fascinating was happening in the physical market. Between early and mid-January, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery in just 7 days. That's roughly 26% of registered inventory disappearing in a single week. And this is where the narrative starts to crack. If silver is crashing because demand is weak, why is physical metal flying off the shelves? Why are dealers reporting premiums spiking? Why is Shanghai trading at a $40 premium to New York? I'm going to tell you something that's going to get me comments calling me a conspiracy theorist, but someone needs to say it. The marriage between the paper price and the physical price is breaking down. For decades, the COMEX spot price has been the global benchmark for silver. If COMEX says silver is $79, then silver is $79. Except now it's not. In Shanghai, physical silver is trading for $120 to $130 according to multiple reports from February 2nd through 5th. In Dubai, premiums are surging. In Europe, dealers are reporting delivery delays and elevated premiums. When spot says 79 but you can't get metal under 100, the pricing mechanism is broken. Let's go back in history for a second, because this isn't the first time we've seen a disconnect between paper and physical. In 1980, silver hit $50 per ounce during the Hunt brothers squeeze. The COMEX changed the rules mid-game, restricting buying and allowing liquidation only. Silver crashed. In 2011, silver hit $49, and then got crushed in a series of margin hikes. The pattern repeats, but here's what's different this time. In 1980 and 2011, there was no massive industrial demand for silver. There was no green energy transition requiring billions of ounces for solar panels. There was no electric vehicle revolution. There was no coordinated 55-nation summit to break reliance on China for critical materials. The fundamentals today are radically different. I want you to do something right now. Open a new tab. Go to any bullion dealer website. APMX, JM Bullion, South Dakota Bullion. Doesn't matter which one. Check the premium on physical silver. As of February 3rd, dealers were quoting premiums anywhere from $3 to $7 over spot for standard products like American Silver Eagles or Canadian Maples. That's on top of the $79 spot price. So you're paying $82 to $86 for an ounce of silver that's supposedly worth $79. Now ask yourself this. If silver is crashing because there's no demand, why are premiums still elevated? Why aren't dealers slashing premiums to move inventory? I'll tell you why. Because the real price of silver, the price at which physical metal actually changes hands, is not $79. It's higher. The paper price is a fiction that's being maintained by leveraged futures traders, while the physical market is telling you a completely different story. Let me hit you with another data point that most YouTubers won't talk about because it complicates the bullish narrative. The dollar index, ticker DXY, is sitting at 97.79 as of February 5, 2026. That's down 9.2% year over year. Normally, a weaker dollar is rocket fuel for silver. Why? Because silver is priced in dollars. When the dollar weakens, it takes more dollars to buy the same ounce of silver, so the nominal price rises. But here's the problem. Over the last week, silver has been crashing while the dollar has been basically flat. That tells you this isn't a currency story, this is a leverage and liquidation story. And while we're on the topic of things that don't make sense, let's talk about the ETF flows. The iShares Silver Trust saw $2.5 billion in net outflows year-to-date despite silver being up 65% over the past year. Think about that. Silver goes up 65% and investors are pulling money out. Then on February 2nd, after the crash, $3.4 billion floods into SLV in one day. That's the largest single-day inflow in the fund's history according to ETF.com data released on February 3rd. Why would retail investors wait for a crash to pile in? Because they believe they're buying the dip. And maybe they're right, or maybe they're about to learn a very expensive lesson about catching falling knives. Here's the contrarian case, and I need you to hear this, because if I'm wrong, this is why. JP Morgan released a note in late January, predicting that silver will crash back to $50 in 2026. Their argument is simple. The move from $30 at the start of 2025 to $121 in January 2026 was a speculative mania driven by retail FOMO and leveraged positioning. Now that leverage is getting flushed, the price will revert to fair value, which they peg somewhere between $50 and $70. Bank of America has a more modest target of $65 average for 2026. HSBC is at $68. If the big banks are right, we could see another 30 to 40% downside from here. That's not fear-mongering. That's just acknowledging that very smart people with access to data you and I don't have are taking the other side of this trade. But here's what those banks aren't accounting for. The physical squeeze. When you have a situation where registered COMEX inventory is dropping, open interest is collapsing, Shanghai is trading at a massive premium, and 55 nations just held a summit to secure critical mineral supplies, you're not in a normal market. You're in a market where the paper price and the physical price are decoupling, and when that happens, one of two things occurs. Either the paper price catches up to the physical price, or the physical market abandons the paper benchmark entirely. If it's the former, we're talking about silver going back to triple digits. If it's the latter, we're talking about a complete breakdown of the COMEX pricing mechanism and a reset of how silver is valued globally. Comment just the word bull if you think silver is going higher from here, or bear if you think we're headed to 50. I want to see where the community stands because this is genuinely one of the most divided markets I've seen in years. So what do you do with this information? First, understand that if you own physical silver, you're not playing the same game as the paper traders. The paper price can crash to $50 tomorrow, and you're still not going to get physical metal at that price if demand stays hot. Physical premiums will just widen further. Second, if you're trading futures or leveraged ETFs, you need to understand that you're not trading silver. You're trading liquidations, margin calls, and institutional games. Those are two completely different assets. Third, watch the delivery data. March delivery starts in less than 10 days. If open interest in the March contract stays elevated and we see another wave of physical withdrawals, something is going to break. Either COMEX runs out of deliverable silver, or they change the rules again. There's a number you need to watch in the coming weeks. 103 million ounces. That's the registered inventory as of early February. If that number keeps dropping and open interest in upcoming delivery months stays above historical norms, the market will be forced to confront a reality it's been avoiding. There's not enough physical silver in the COMEX system to satisfy everyone who's long paper contracts. And when that reality hits, the fireworks begin. Let me tell you a quick story. In early 2023, I was watching silver trade in the mid-20s and thinking it looked cheap. I didn't pull the trigger. By late 2025, silver was at 70. I missed the entire move because I was waiting for confirmation, waiting for the perfect entry, waiting for everyone else to validate what I already believed. That hesitation cost me a life-changing position. I'm not telling you to buy silver at $79. I'm not telling you to sell it either. I'm telling you that if you wait for certainty in markets, you'll always be late. The time to act is when you're uncertain, when the data is messy, when half the world thinks you're crazy. That's when fortunes are made. So here's what I'm watching. First, COMEX inventory. If registered silver keeps dropping below 100 million ounces, that's a red alert. Second, Shanghai premiums. If that $40 gap persists or widens, it confirms the physical market has decoupled. Third, open interest for March and May contracts. If we see a surge in contracts standing for delivery, that's the tell that smart money is taking metal off the exchange. Fourth, dealer premiums. If premiums spike above $10 over spot, that's a signal the physical market is tightening regardless of what paper does. And fifth, government action. If we see more countries announcing strategic stockpiles or tariffs on silver exports, that's game over for the bearish case. You're not just watching a metal trade. You're watching the slow-motion collapse of a pricing system that's been in place for 50 years. The COMEX has been the global benchmark for precious metals since the 1970s. But when you can't get physical metal anywhere close to the COMEX quote, the benchmark becomes irrelevant. Markets abhor a pricing vacuum. If COMEX loses credibility, something else will replace it. Maybe it's Shanghai. Maybe it's a basket of physical dealer quotes. Maybe it's a blockchain-based settlement system. I don't know. But what I do know is that when the benchmark breaks, the volatility during the transition is where the real money is made and lost. Here's the philosophical truth nobody wants to say out loud. Silver isn't just a trade. It's a bet on whether the system works. If you believe that central banks, governments, and large institutions will continue to manage markets smoothly, that pricing mechanisms will hold, that paper and physical will stay linked, then you should probably stay away from silver. But if you believe that we're in an era of currency debasement, strategic resource competition, and financial system fragility, then silver isn't speculation. It's insurance. And the premium you pay today might look like a bargain in 12 months. March delivery starts in less than 2 weeks. Between now and then, we're going to see whether the players standing for physical contracts can actually get their metal. If they can, the market will stabilize and the bears will be vindicated. If they can't, if we see delivery failures or another rule change, that's when the narrative shifts permanently. I'll be tracking the delivery data daily, and I'll have another video in 48 hours breaking down exactly what's happening in real time. If you want to stay ahead of this, you need to be here for that update, because this story is moving faster than any metal market I've ever covered. One last thing. If you've been stacking since before 2020, comment with the old man emoji. If you got in after, comment with the new emoji. I want to see how many veterans versus newcomers are watching this. And if you found value in this breakdown, share this video with someone who's confused about what's happening because most of the coverage out there is either blindly bullish or dismissively bearish. The truth is neither. The truth is that we're in uncharted territory, and the only thing that matters is the data. What happened yesterday isn't about whether silver goes up or down next week. It's about whether paper and physical are still the same asset. And if they're not, the next 12 months are going to redefine how an entire generation thinks about precious metals. Stay sharp. AG JHON AG. Out.